Hi everyone, welcome to the third workshop conducted by TCS for the Management Case Study exam November 2024. So this is a webinar and a workshop dedicated in terms of your P2 related exam preparation. So first things first, the session plan for today, we will firstly provide you with a syllabus overview for P2. As you may be aware, some of you are exempted from sitting for the P2 OTQ examination. So you are coming through an exempted route or the accelerated route through FLP. So you need to understand what would be some of the key components of the P2 syllabus that you need to be thorough with to tackle this case study examination. Thereafter, we will take you through an exam-style task from one of our mock examinations. In fact, it is the first mock exam that we have offered on our platform, which has also been made available free. So you would have or you can attempt it in the exam platform as well. And thereafter, we will open up this session for a Q&A where you can raise any questions pertaining to P2. And of course, if you have any questions arising from the other syllabus areas, you can raise them as well. All right, so with that in mind, let's get to the session. But a reminder about our study plan, especially the 3-week study plan. And remember, according to the study plan, we are on the 2nd of November, the week starting 2nd of November, and we are on this workshop today, P2. And as you note here, we have one more workshop coming up, and that is on the next Saturday. So please make sure you attend this workshop also, because we will be discussing some important tips and we'll be offering you some guidance with regard to final exam preparation, which is essential to make sure that you don't have any last minute hiccups or to make sure that you stay calm and composed facing the examination. All right, also a reminder about our 3-week study plan. And please remember what you are required to do during this week. So make sure you stick to the study plan. Those who already started with our 7-week study plan, you can stick to the same study plan. But this is for those who got started a little later. All right, so you have a copy of these, so we will actually not spend too much time on this. So let's get to the discussion. The P2 syllabus overview. Now you can look at the syllabus overview from different perspectives. You can look at the examination blueprint, or you can simply look at the content in CIMA approved study texts. But what we have done is we have developed a summary covering the key areas, and we have made sure that we cover all these areas in our mock examinations. So we will take you to the syllabus overview, which is also included in this document that we have shared with you. So remember, with regard to P2, Advanced Management Accounting, you need to be thorough with investment appraisal to start with. This is a key component of the P2 syllabus. In fact, management accounting, if you look at long-term decision making, the topic of investment appraisal is so important. So remember that there are investment appraisal techniques, and we would highlight that NPV, IRR, and payback period are the most important techniques. Of course, ARR is in the mix, but what we've seen is that the questions are mostly related to NPV, then IRR, and then payback period. For the simple reason that NPV is a more preferred method of investment appraisal compared to, say, IRR or, say, a payback period. So you need to be thorough with these different investment appraisal techniques. Remember, you don't make decisions based on a single investment appraisal technique. You will look at the absolute return coming from an NPV appraisal. You will also look at the relative return, the percentage return based on IRR. You might also want to look at how faster, how sooner can you recover your initial investment from a risk management perspective. That is where you will have a look at payback period. So different investment appraisal methods serve different purposes. So you need to be thorough as to when these methods would be relevant. And you should also be thorough with the pros and cons of using these methods, because every method has its own advantages as well as limitations. And also remember, when it comes to NPV, uh, the cash flow forecasting aspect has been frequently tested. So you could be given information about an NPV appraisal, and you could be asked what would be the relevant cash flows relevant for the investment appraisal. Alternatively, and more popularly, you could be tested on what would be the challenges associated with predicting the cash flows for an NPV appraisal. So these are some of the challenging tasks that you will encounter. And it's important that you be prepared for it, because it has to be based on the given scenario. You cannot write technical or theoretical points when a task is presented to you like that. So please make sure that you cover all these aspects with regard to your preparation when it comes to investment appraisal. And of course, we've got you covered in our mock examination. So if you have access to our materials, don't worry, you will encounter some of these in the upcoming mock examinations. And of course, the topic of real options. In recent sittings, we have also seen real options being tested from a very practical perspective. And in fact, those who are following our study plan have already gone through this topic. Just be prepared, just have an understanding of the concept of real options, and just know that the real options concept will relate to the given scenario. It's all about having flexibility with regard to a particular investment. Thereafter, you can look at responsibility centers as another key component of the syllabus. And we've got you covered today, because the mock exam task that we will be discussing with you is on this topic in the syllabus. So I will not go through these different points in detail for now, because it's coming up next. Please be mindful of the performance measures, KPIs discussion part of our syllabus, because when it comes to advanced management accounting or advanced performance management, you need to know that there are financial measures that we use, but we also need to be aware of some non-financial performance measures or key performance indicators. So you could be presented with some KPIs or performance measures, some sort of an interpretation could be required, or you could be discussed to evaluate the appropriateness of using certain performance measures. So just be prepared to apply this to a given scenario. And of course, the concept of balanced scorecard perfectly fits into the performance measures that an organization would like to have, because it looks at 4 different perspectives, and not only the financial perspective, but also the non-financial perspectives. So it could be performance measures, or it could be the balanced scorecard framework, which encompasses the performance measures. And just be mindful, we observed one of the past variant tasks. The examiner simply used the term scorecard without using its full technical reference, which is balanced scorecard. So there was a bit of a confusion among candidates. What did the examiner mean by the scorecard? Well, it's actually the balanced scorecard. The examiner opted to use the shortened form. So just be clear and just be prepared for this topic as well. Benchmarking is yet another topic that is relevant, especially given the fact that we have a competition from different players in the market, and you might also want to look at your operational efficiencies, because if you look at the financials, you will observe that maybe our operations could be more efficient. There is still scope for improvement in the margins. So prepared with the concept of benchmarking from different perspectives, and most importantly, transfer pricing. So it's yet another area that is frequently tested. You don't know how it's going to come. And usually it's one of the challenging areas for candidates. So please be prepared. Just know the different transfer pricing methods, just know the pros and cons of using different methods. And of course, you will need to apply it to a given context. So you need to have a broader understanding of how different transfer prices or transfer pricing methods become relevant. So when should we use them? When should they be recommended is something that you should make sure you cover as part of your preparation. Furthermore, with regard to cost management techniques, you can be expected to demonstrate your knowledge on concepts like activity-based management, cost transformation techniques, target costing, life cycle costing could also be relevant this time because we could come up with new products and they will have a life cycle. So you need to be thorough with these costing techniques. And of course, for a company such as Shinyglas, which is built on product innovation and reputation for quality, concepts such as TQN and business process re-engineering, BPR, could be very important. And of course, the less frequently tested topic of value chain analysis, because value chain analysis, as you know, is more relevant for a manufacturing organization. And after a couple of pre-scenes or exam sittings, you have been presented with a company which is into manufacturing and sales. So value chain analysis is another important topic that you might want to make sure you cover this time around. Pricing strategy, we've seen a question somewhere in one of the 6 variants, if not more, because it's important that you be thorough with new product developments and what would be the pricing strategies that we will need to use. We have not been provided with much information about pricing strategies in the pre-scene. One thing we know is that we price our products higher than our competitors, and that's because we can justify our prices thanks to the quality that we offer. But remember the wordings in the pre-scene. We are ranked first, but we are ranked first in terms of value for money. So I hope you remember these key points from the pre-scene, because those will be relevant when you are constructing an argument when it comes to pricing strategy. So we can't simply say we are premium priced player in the market. No, we are charging higher, but then the comparison is about value for money. And of course, we are justifying the quality, that the price, thanks to the quality that we offer. Furthermore, business risks and mitigation, another frequently tested topic in the examination. Definitely, it's a topic you can expect in the exams. So just know that there are different categories of risk, but you have to be very practical. Don't try to categorize the risks in a scenario. Try to identify the risks, because sometimes candidates try to fit in the risks that they see in a particular scenario into these headings. They try to see, can I name this as operational risk? And maybe it is a risk, but it is not an operational risk. So sometimes candidates end up putting the heading as operational risk, but then they explain a risk which is not operational in nature. So if you look at this, the examiner's answers for past variants, you will observe that it's not about naming the risk, but it's about identifying the risk, explaining why it is a risk, and being able to suggest mitigation strategies. So this is also something that we've extensively covered in our mocks. You will see not once, but more than once, we have focused on business risks, because business risks depend on the given context, and you cannot go prepared with a set of risks and mitigation strategies. You have to look at it contextually. And let me also remind you, the least expected category of risk, contractual inadequacy risk. When this first got tested as an individual requirement, some candidates absolutely had no clue what to discuss under contractual inadequacy. And to the surprise of many, the examiner chose to word it exactly as contractual inadequacy risk in the subtask. and the candidates still couldn't figure it out. So it's important that you have an idea about these different types of risks. And most importantly, remember, business risks is all about application. And we've got you covered in mock one. We have our very first task on business risks. It was already discussed in our answering technique webinar. So in case if you missed the discussion, please refer back to the recording. Furthermore, with regard to investment appraisal as well as risks management, you should also be thorough with the concepts such as sensitivity analysis. You can even add scenario planning here. Of course, it's relevant from a E2 perspective, but it could also be combined with investment appraisal. So the concepts of sensitivity analysis as well as scenario planning look at investments from the perspective of what if scenarios, right? So you should be able to construct those what if scenarios for an investment appraisal related requirement presented to you in the examination. And of course, stress testing. This is, of course, a stressful area for the candidates because most don't have a clear picture of what exactly stress testing is. And it could be tested from different perspectives. We have had stress testing being tested from two main perspectives. One in general. So if you look at one of the past variants related to the pre-scene called piping beverages, we had a question on stress testing from a common perspective, a general perspective. But if you look at past papers related to a company named Frinta, you will see that the examiner went into the details of stress testing. He was very particular about four aspects of stress testing, and he wanted the answers to be very specific on those. So don't worry, we've got you covered in our mock exams as well. So this is basically a summary of some of the key topics. And let me make a disclaimer. We have not listed each and every topic that you find in the study text, but we have given you the subtopics, the headings that you need to focus on. So when you cover these main headings, these other subtopics will also be covered as part of it. So this is basically the overview with regard to P2. And let me remind you, uh, you if you have not yet invested, or if you do not have access to mock exams, 3-hour mock exams, which have 4 sections, 4 tasks similar to the exam, you might find our products helpful, especially considering the timeline that you have. If you still don't have full mock exams, you could basically look at our value pack, where we have made sure that we have 6 mock exams which reflect the exam standard and which cover all these areas, not only the P2 areas that I'm highlighting, but if you have been following our webinars, you know that we have also covered F2 as well as E2 areas in our mock examinations. So you might find this product useful closer to the exam if you still have not invested. And as you can see, it's not only the mock exams and the suggested answers, you will also have access to a number of other study resources and materials, which you will find extremely helpful to make sure you pass first time. And don't consider investment in good study material as unnecessary, because as you know, costs of quality, right? The failure costs are higher than prevention costs. And of course, for candidates who might be looking at more study support, especially for candidates who are looking at preparing for the February examination, you might want to consider investing in the premium pack, because in addition to all these resources, you will have access to the TCS online mock exam platform, which is an exact replica of the Pearson exam platform. So it's like you do the exam 6 times before you take the actual exam. And you can practice multiple times. So it's not that you can do one mock exam once, but if you want to practice it again, you can. So to those who have not attempted exams before on the exam platform, this could be a much helpful resource in preparation of the examination. And don't forget the one-to-one tutor feedback that we offer on the 3 mocks out of the 6. So these will be offered in mock 4, 5, 6. And you may have seen the samples. We give extensive feedback, and this is one of those critical success factors for candidates who have not taken the traditional CIMA route of sitting for P2, F2, and E2 OTQ examinations. And the real value addition would also be the 20 master classes that we offer. Actually, it's more than that, because we have the master classes, but each master class will discuss 2 subtasks. So you will actually get exposed to the discussion of all these syllabus areas from an exam task perspective. So this is for those who are considering exam preps for February, because you will need some time to go through these materials. But if anyone feels that you are underprepared and you want to attempt as many mocks as possible in an exam platform and receive feedback, it's still not too late, because you still have enough time to practice mock exams in the platform and receive feedback. All right, so that's about the study resources that you can gain access to with us. And we can move on to the next session, next item in discussion for today, which is to take you through a P2 related exam standard task and the answer discussion. So for this, we will refer back to our first mock exam, and I hope you remember the narrative. We are looking at diversification, and we wanted to diversify into manufacturing, sustainable and eco-friendly, as well as technologically driven smart glasses, right? So we saw that we wanted to diversify, but then we actually wanted to go ahead with an acquisition, right? The simple reason is, rather than setting up a company from scratch, we can acquire a company and we can gain an advantage through the existing operations as well as the market that the company has. Of course, I got a small question on the chat with regard to the pricing. You will see that the prices for the value pack are set at £249, and you have 2 options with regard to the premium pack as well. And I can assure you that we offer value for money, just like Shinyglas. We try to give you the best resources, and those who have invested with us would agree that the price would justify the quality. All right, so coming back to the mock exam, remember the second section presented us with a development that we are considering an acquisition. And remember, we discussed acquisition accounting in the last week's webinar, and we are actually moving on from there, and we see that the acquisition has been completed as we come to section 4, right? So we are told that a month has passed and Shinyglas has successfully acquired an 80% stake in Eco-Insulate Innovations, while the remaining 20% being owned by the 2 founding shareholders of the company. So we have an email, and this email is, of course, coming straight from the finance director, because apparently the senior financial manager is on leave, so the director is coming in direct contact with us. So let's stick to our routine. Let's read the question, and let's read through the reference material and then discuss the answer. So we are told that I am pleased to inform you that the acquisition of Eco-Insulate Innovations has been successfully concluded. The integration process is now underway, and the board has discussed several matters concerning how to position Eco-Insulate Innovations within the Shinyglas Group structure. I would now appreciate your input on the post-acquisition strategy discussed at the last board meeting. The integration of eco-insulate innovations is critical for expanding Shinyglas's sustainability portfolio, and we want to ensure that the classification of the subsidiary aligns with our broader strategic objectives. I know where this is getting into because this company is now part of our group. And remember, performance management within a group, you need to decide what type of responsibility center you want to classify this new SBU, Strategic Business Unit, or the subsidiary within the group. So that's where we are getting into. So the background is being provided. Let's read further. I would appreciate if you could address the following. Right now, remember, you could straight away read the subtasks, but we always recommend you to refer to the reference material, because if you skip reading the reference material and if you read through the subtasks right away, your mind might start to project that subtasks in a different way, and the answer would be popping up in your mind in a different way. So to get a holistic view of the requirement, it's important that you also read through the reference material. So this, as usual, is an extract from board minutes. We are told that the board considered two critical post-acquisition matters regarding eco-insulate innovations. First, the classification of eco-insulate innovations within Shinyglas's group structure as an appropriate responsibility center. The discussion focused on aligning the subsidiary's strategic goals with Shinyglas's broader objectives, especially in terms of enhancing product innovation and reinforcing our value for money reputation in the market. The company's focus on high performance, eco-friendly materials make it a crucial addition to Shinyglas's sustainability portfolio. So remember, we are being given some background as to what this new company is all about. So there is increased focus on eco-friendly materials and sustainability. Furthermore, we are told that the finance director suggested assembling a cross-functional team, right? So this is the extract from the board minute. So even the finance director has raised some concerns. And we will skip reading this part for the simple reason that this is related to part B of the requirement. So part B is on managing and creating an effective team, which is E2 related. So you can attempt it on your own, and we will actually keep the focus to the first subtask, considering the topic of our webinar today, as well as the time constraints associated with the session. So let me also remind you, if you look at our mock examinations, we have replicated the questions, subtasks from past papers. So you don't have to worry about how these topics had been tested in the past papers. What we've done is a compilation of the same, but of course with application to the present case study. And of course, remember, when it comes to MCS, we've highlighted this before, it's a paper in the middle of the curriculum. It's a paper between operational case study and strategic case study. It's a paper which sometimes students find difficult to understand because they will see technical questions. They all of a sudden see something technical with regard to a ratio like what they would see in F1 and which would have been tested in OCS. And all of a sudden they see something practical which they can't identify as either P2 or F2 or E2 because you are being prepped for the strategic case study. So we've also tried to cover some practical scenarios that would still be within the syllabus, but will appear as though they are, out of the scope. That's because, you can be, as a finance manager, expected to be faced with such scenarios, and they will relate to the case study. So if you look at these two subtasks, we have taken them from the past papers, and let's focus on the subtask relevant for today. Identify the different types of responsibility centers and evaluate their appropriateness. So just make sure that you don't forget the conjunction here. And you need to identify what are the different types of responsibility centers. Now, sometimes the examiner gives you some extra help. The examiner will tell you what types of responsibility centers he wants you to discuss. And that is, of course, not to make your life easy, but he wants your answer specifically focused on, let's say, 1 or 2 options out of the 4 that you have. Because when you are presented with 4 options, it's easy for you to construct an answer. You know, you can discuss all 4 of these. And especially when the requirement is weighted at 60%, as you can see, right? It's easy to have broader coverage because you will be discussing about 4 different types of responsibility centers. But imagine the examiner is very specific, states that you have to only discuss 2 types of responsibility centers, and the requirement is weighted at 60%. That means the examiner wants depth in your answers, right? So that's basically the catch there. You need to go in detail as to the relevance of the 2 specific responsibility centers that the examiner himself has stated in the subtask. So here, of course, we can discuss all 4 types of responsibility centers, and we have to evaluate their appropriateness. So when you're planning your answer, you should have come up with all these headings. There should have been a cost center discussion, revenue center, profit center, investment center, and under each of those headings, you should make sure that you discuss their appropriateness, or rather evaluate their appropriateness, right? And this is not from a theoretical perspective. You have to evaluate the appropriateness with regard to the classification of our new subsidiary, right? It's about classification of the new subsidiary within the Shinyglas group. So I hope the requirement is clear, and don't worry, we have a Q&A time coming up. So if you have any questions, you can raise it at that time as well. Just to make sure that the flow is not interrupted, I'll keep the discussion focused on the answer for now. So if you look at our answer plan, we have followed the same approach. What we've done is we have developed 4 subheadings, and our suggested answers also follow the same approach. And we have discussed about the appropriateness under each of those headings. And of course, we have provided a conclusion, right? And this is not an unnecessary conclusion, because I need to highlight that when we were marking some of the scripts of our candidates, we observed that they are writing a conclusion which is not necessary, right? I would urge you to refer to our suggested answers. And what we have done in our suggested answers is we have tried to make sure that our answers, as much as possible, reflect the answers of a candidate, a well-prepared candidate within time constraints. So that is something which we are very particular about. We don't have these unnecessary introductions which you don't find in examiner's answers. We don't have these unnecessary conclusions which we don't see in examiner's answers. And we don't have these unnecessary formalities, right? Because they can give a nice look and feel in the materials. But what you need to understand is when a candidate compares his or her answers with the suggested answers, you should not feel intimidated, or you should not feel like, okay, it's impossible to do this, right? So please make sure that you have a close look at our suggested answers as well. And you don't have time to basically refer to past paper answers. But if you refer to past paper answers, you will see that it resembles the structure that we follow, right? So please make sure that you provide an introduction and a conclusion only if necessary, only if it is value adding. Now, if you look at this answer, we have in fact added a small introduction. It's a very brief introduction, because when you are determining the appropriate type of responsibility center, there is a guiding principle. There is some guidance as to how you choose which responsibility center classification is appropriate for a particular responsibility center. And that guiding principle is controllability, which is what we have highlighted in our introduction. So we are stating that there are 4 types of responsibility centers, and we are very clear that controllability, the principle of controllability, is the guiding factor when determining the appropriate type of responsibility center. So this is a value-adding introduction. Now, sometimes we see that candidates start with a paragraph agreeing and complimenting the board of directors. They say, "Oh, I realize that it is important to classify this. I agree with the board." Or, "We have made the acquisition and it is really great for the company." Well, we know all that. Your director knows all that. You don't have to tell the director, "I agree with you. I appreciate the company's decision to acquire this company, or I also understand the synergies." You are just an employee, right? Just answer the question that is presented to you. So avoid these agreeing or complimenting or praising introductions, and just make sure that within the 45 minutes that you have, you write points which will gain you marks in terms of the marking guide that is set. So marking guide unfortunately does not have marks allocated for nice pleasantries or nice introductions, or trying to come up with a conclusion of the points that you have already stated. So get the key points in first, right, which will guarantee you marks and which will give you the best chance of passing. All right, so let's get to the answer discussion. So we have 4 types of responsibility centers. And the first type is a cost center classification, right? So make sure you briefly explain what a cost center is, right? And when you classify a unit as a cost center, it means that the management of that division or the management of that subsidiary, in our case, will have responsibility and accountability only for controlling costs, because that's why we name it as a cost center. So what you're going to say is, look here, you are the board of management for this division, or the directors for this division, or you are the divisional head, and your responsibility is only with regard to controlling costs. That means you have no responsibility with regard to revenues. So sales is not your problem. We won't question you, or we won't hold you accountable for revenues. And if you don't have any responsibility for revenues, that means you don't have any responsibility for profit also. Because remember, profit is equal to revenue minus costs. So if you are not responsible for revenues, then we can't hold you responsible for profits also. And of course, if it's only about controlling costs, then as a business or as a separate entity, you don't have to make any investment related decisions either. So a cost center classification is all about making sure that the control is with regard to costs. So no responsibility with regard to revenues or investments. Now, this sort of a classification is relevant. For example, if you consider a factory within the group, operating in a remote location or operating separately, and there is a factory manager or there's a management for the factory, and their only responsibility would be to undertake the manufacturing based on the forecasts. So you have the sales department, so they will do the forecasting with regard to demand, and they will, of course, as you know, the budgetary process, they will say, okay, this is our sales forecast, and this is the inventory levels that we would like to have. And based on those instructions, the factory will start manufacturing. So the responsibility of the manager for the factory would be to make sure that there are budgeted costs, right? Remember, we prepare standard cost cards, and then there's a budget. So the responsibility of the manager would be to make sure that the manufacturing the production happens within the budget, and of course, the overheads in the factory remain within the budget. That's all his responsibility. He has no business with regard to the sales of the products manufactured in the factory. So in the present case, what we are dealing with is a company which has been independently operating, and this is why sometimes the knowledge about the previous sections is important, because if you recall, we were told that this is a company which has a customer base currently, right? So we were told that it's a leading producer of sustainable insulation materials, and they sell their products to a growing commercial and residential customer base in Templeton. So they already have customers, they already have sales. So it's a company which has its own manufacturing and its own customer base. So when you are acquiring a company which has its own market and is making revenues, you cannot classify that subsidiary as a cost center. Because if you do that, you're telling the manager, okay, hereafter, your only problem is to manage costs, right? So we are going to say that this classification is inappropriate, or it's not suited for eco-insulate, for the simple reason they currently sell to residential and commercial customers. Let them sell, let them bring revenue to the group. So they should continue to be responsible for revenue generation. So which takes us to the next type of responsibility center, which is a revenue center. Now, in a revenue center, the responsibility is once again with regard to one aspect. I repeat, one aspect, and that one aspect is the generation of revenue. And of course, how do we generate revenue? It's simply from sales. So if you classify a division as a revenue center, that means the management or the divisional manager has responsibility only with regard to sales revenue. And this classification would be suited, say, for instance, you are a large or a multinational company, and you undertake the manufacturing in one country or in one location, but you have different countries in which you sell your products. So you're establishing your subsidiaries in different countries as, say, for instance, a distribution or a regional sales division. So when you have regional sales divisions, then of course a revenue center classification would be appropriate, because they don't manufacture, they have no responsibility with regard to costs, their only responsibility is with regard to sales in that region. So no responsibility for revenues, sorry, no responsibility for costs, I beg your pardon, and no responsibility for investments, just sales. Get the sales done, hit the targets, and make sure you bring revenue to the company. And of course, revenue is something that they should be and ought to be responsible for. But remember, as I said, if you classify it as a revenue center, you are saying that they would not be responsible for costs. Because a revenue center means you only are responsible for revenues, and that is inappropriate. They are undertaking manufacturing, and they currently have their own factory, and they should continue to be responsible for their production as well as operational costs. You can't say that, okay, look here, hereafter you only need to bring sales to our group. That's not going to work, right? And for this reason, cost center classification is out, and revenue center classification is also out, but we can make a strong case for a profit center classification, because in a profit center, the division or the divisional manager is responsible for both revenue generation, sales, as well as costs. And of course, if you have responsibility for revenue as well as costs, it means we are looking at how profitable are your operations. So currently, this is how Eco-Insulate is operating. They are making profits, and let them continue to make profits, right? So in this instance, they would be held accountable for the profitability of the divisional operations, And of course, one thing is that they will not have any authority for investment decisions. So I'll explain what we mean by investment decisions shortly. But for now, please remember that a profit center is responsible for sales as well as for costs. So how do we evaluate the performance of a profit center? We have to look at profitability related KPIs. You might want to look at something like a GP margin or an NP margin, right? You only look at sales and costs, right? And remember, I did not mention ROI, return on investment. I just said GP, NP, because that is their responsibility. So this would be appropriate for this new subsidiary for the simple reason it will encourage them to maximize profitability, because not only sales they are responsible for but also for costs. So they will make decisions to make sure that the division's profits increase. So it will basically make them more efficient, and they will continue to operate like how they have operated so far, right? Only thing is, we would be taking one responsibility away from them, from how they are currently operating. As an independent entity, they are responsible for costs, they are responsible for revenues as an independent entity before acquisition. They are responsible for profits in that case, and they would also be responsible for investment decisions, right? It's their call to decide what investments they would be making. But once they become part of the group, Shinyglas has to make a decision. Okay, are we going to hold them accountable for profits? And are we going to make them accountable for profits, that is returns on investments, ROI? So in that case, you would give the highest level of autonomy where they will operate with independence from the group with regard to even investment decisions. So when it comes to investment center, the manager or the management of the division will have responsibility for profits, right? So it is a profit center, plus it is also an investment center, because they now have the freedom, the independence to make investment decisions. Now you can look at it from two perspectives, investment decisions. You don't have to go into this detail, but just giving you some background. Some candidates think investment decisions only relate to decisions with regard to investments in non-current assets, right? That's correct. If you have the authority, if you have the freedom to decide on your own whether you want to make new investments in your division, that means you are an investment center. You have that autonomy, right? Only thing is, at the end of the period, the group's board of directors will come to you and ask, okay, you made investments, fine, but where is the ROI? Where's the return on the investment? So it's your call. If you want to invest further, you want to expand your facility, you want to buy new machinery, that's fine. But at the end of the day, we will come asking you for a return on the investment, right? So remember, this is where ROI becomes an important performance measurement tool here, right? So RI is better than ROI. Well, there are pros and cons with both, right? You can argue economic value added is better than both RI and ROI, right? So of course, you can discuss the pros and cons of each of these performance measures, but I will not go into it because that is a separate topic, performance measures for a responsibility center. Right now, we are basically discussing the classifications. So you will have to justify your investments through the returns that you make, right? So one perspective is to look at it from the freedom, the autonomy to make decisions with regard to investments, and of course, the financing decisions. Can the subsidiary decide on its own with regard to financing? Can they borrow without the approval of the group management? So when it comes to investment center classifications, even if you can't make financing decisions, right? Although you may not be able to make financing decisions, if you have the autonomy to make investment decisions, that would be sufficient to classify you as an investment center. So financing decision is not always compulsory, but generally, if you want to give them the highest level of freedom, you would enable uh, them to make decisions pertaining to financing as well. But of course, in reality, in the real world, you set some limits, right? You set some limits. Sometimes subsidiary might need a short-term credit facility, or it might need a small amount of borrowing, a long-term borrowing for a year or two. But if the borrowing amount exceeds a particular threshold, or if it exceeds a particular level of gearing, right, then of course you require the investment center to get the approval from the group. So you can basically you have the flexibility in real world to decide how you want to manage the investment center, right? So that's a little more detail. You need not go into that extent, but just remember why we should make Eco-Insulate as an investment center. Well, if you want to make sure that they have the highest level of autonomy, if you want to facilitate faster decision making. See, because this is a different line of business, and our current management, our board of directors may not know when assets need to be replaced. We may not know when we will need to procure new machinery or new equipment, or when we need to invest in, let's say, an intangible asset. When should we need a new software, or when should we need to go for a particular license? We may not fully understand the operations and the nature of this new line of business. So if they have to consult us, then there will be some delays in approvals, and that could delay investments, in non-current assets. And sometimes the competitors might gain an advantage because we are not rapidly making decisions, and we are not actually seizing those opportunities that arise in the market. And of course, generally after an acquisition, uh, the subsidiaries management as well as the staff have a bit of a fear as to how they will be managed coming under a new management, coming under a new group of companies. But if you let them operate as an investment center, that means there will be more autonomy, and it can be motivating to the subsidiaries both. And of course, you can definitely raise some concerns that, look here, that means you won't have any control on the flip side, right? You give autonomy, and of course, you will not have much control, right? So it's all about understanding whether you, the Shinyglas board, are more capable of making better decisions and managing the subsidiary better, or whether it would be better managed with its existing board and its existing decision-making process. So if you think you are superior, you can add more value, and you can take charge and bring more benefits to the group thanks to your decision making, well, then go ahead. But if you think, no, they are better off operating independent, then of course you go with an investment center classification. Now, one problem to highlight here is that if it's an investment center, uh, the subsidiary will decide with regard to new investments. So let's say financing, and you have two options with regard to financing. You can opt for equity, and you can also opt for debt. So if this subsidiary opts to go for equity finance, right? New investment, new shares need to come in. Then, of course, it is our responsibility, the parent company's responsibility, to fund 80%, right? Because the scenario, the reference, the start of the question itself, we were told that there is a non-controlling interest, a minority shareholding of 20%, right? So this particular point that I'm discussing is something that the examiner himself had raised in one of those past papers, and it's something that was discussed particularly in the suggested answers as well, right? So if we make it as an investment center, we have a small problem. The subsidiary might decide, okay, we want new funding and we want our shareholders to invest, right? Now, the problem is, we, of course, would invest. It's our subsidiary. We have an 80% stake. But the question is, will the two founding shareholders, the two remaining shareholders, want to invest further in the company? Because they don't have a controlling stake, right? And if they consider, okay, this investment is not necessary, I am not going to put my money as a minority shareholder to finance further. In those cases, the entire funding requirement, say you need 100 million, right? You use this 100 million and you generate a profit, okay? That profit will be split 80-20, right? Because dividends will be split 80-20. Okay. So whatever profits we make, 20% of the profits will go to the non-controlling interest. So we are planning on investing another 100 million, and whatever returns we make from that 100 million will be split 80-20. Okay. So new investment, subsidiary is willing to make the 80% share of the investment, but non-controlling interest is not willing. Right? Let's say it's a new factory. We want to construct a new factory, and we are going to increase capacity and we are going to increase sales, and the increased sales will bring increased profits, and increased profits will be split 80-20, right? But let's say the non-controlling interest, the minority shareholders are not interested in investing their share of the investment. In that case, what will need to happen is 100% of the investment, right? 100% of the investment will need to be borne by the by the group, by the parent company, because non-controlling interest is not interested in investing, right? Of course, there will be a change in shareholding percentages. Definitely, the shareholding percentages will change because you're bringing in more equity, right? But we need to also understand the non-controlling interest or the minority shareholders are not investing anything, but from these extra profits that we might make, they will still get the 20% share, or maybe a little lesser, because as you know, when you issue new shares, the shareholding percentages will change. So they might get a little lesser share, but still effectively without investing more, they are getting more in absolute terms. So we will need to be absolutely clear. We will need to have a discussion with the minority shareholders with regard to additional investments. If required, if we have to make additional investment, would you make on an 80-20% ratio, right? So you will need to have a clear agreement with minority shareholders, and you might even look at share buybacks sometimes if they are not willing to invest, but they are only wanting to take profits out of the business. So that is one of the problems. Of course, there are other problems, but this is something that the examiner had specifically highlighted in one of the past papers, and you will find it helpful to bear that in mind, because it's something that the examiner considered important in the past. So that's about the answer discussion. And as a conclusion, what we can say, we have not been asked to provide a recommendation, but sometimes you are also required to discuss the different types of responsibility centers and to finally recommend with justification. So when it comes to recommendation, ideally, you should have or you should recommend one of these two, a profit center classification or an investment center classification. That should be your recommendation. We have not recommended, let me make it very clear, we have not recommended a profit center or an investment center, but what we have said is a conclusion with regard to the appropriateness, right? So what we are saying is, ultimately, the board of directors should determine how much authority or autonomy they would like to give to the subsidiaries management. You want to give the highest level of autonomy, then go with investment center. You want to make sure that you make the investment decisions, then make it as a profit center, right? So it has to be one of these two, and that is basically our conclusion, right? With regard to the appropriateness, because we are very clear, cost center is inappropriate, revenue center is inappropriate, but these two are appropriate, and you can decide based on the level of autonomy that you wish to grant to the new subsidiary. So that's about the answer discussion. And of course, if you have any questions, you are more than welcome to discuss it with us. So I'll open the session for a Q&A. And of course, a kind reminder about how successful our candidates have been in the past, especially the most recent sitting. And this is one of the candidates who had actually given us a review and managing to pass the case study. And I am sure we have many success stories. If you visit Trustpilot or if you check the reviews, you will see that many candidates have recommended us. And we have, thanks to the efforts of both our tutors as well as the candidates, students, most importantly, sticking to the study plan, making optimum use of the resources, we have been able to achieve a 95% pass rate in the most recent sittings. And this was one of the highest in recent times. And of course, we should give credit to where it's due. The candidates who stuck to the study plan, who trusted the process, and who never felt demotivated when we gave them critical feedback, looked at it positively and worked hard, brought these results to us. So that's about our most recent sitting, and let me open the session for a Q&A. And to facilitate the discussion, let me pause the recording for a while. So thank you for your questions, and hope I was able to address them as best as I can. If you still have any questions that you need answers for, do raise them up in the WhatsApp groups, and we will respond as fast as we can. And of course, a reminder about the upcoming webinar, the final workshop, that would be on Saturday. And please do take note of the time. It's a little different to the times that we have had our workshops in the last 2 to 3 weeks. So once again, thank you for joining, and uh, just a reminder about how you can reach out to us, and also a reminder about our social media handles where you can access the content, especially the YouTube channel, where you will find the recordings of the webinars and the workshops that we've conducted, as well as the short clips that we've uploaded covering the pre-scene, as well as some key points with regard to exam prep. So once again, thank you very much, everyone, for joining the workshops, and hope to see you in the final webinar as well. Until that time, thank you and have a good night.